Well, I believe we did start a correction last week, and I do think we have another leg down. The last 2 days, we've seen some attempts by the stock market to try and climb back to come off the lows. But the credit market, the U.S. credit market, has worsened. And it's not just the credit market, but it's also the credit derivatives. Things like financial credit derivatives, which are so key to our financial system. When we go into a correction like we did when the U.S. got downgraded, or when Greece got into trouble, or as we're approaching the fiscal cliff, we created a lot of turbulence in both the credit and credit derivative markets. Right. And I'm seeing the same type of action as I saw then. In fact, it looks very similar to the 2-month correction we had last May and June. So I think there's another leg down.
Well, we're getting close to a buying opportunity in emerging market equities, only because when I see the outflows, Kelly, you know, we had a record outflow, I shouldn't say record, but the largest outflows last week since 2011. And when you see that, it may be early, but it's a sign that you're getting closer to the bottom. And I would agree with Brian, credit all the indicators we have. We've created an index of our 21 Lehman risk indicators in Asia. They're all elevated, which tells me that equities are going to have a tough time in the short run.
What we do notice, basically looking at the past 10 years of these numbers, really is typically for January and February, because of the Chinese New Year effect, we tend to see the PMI numbers starting on a relatively soft note. It tends to give up some of the gains in the first couple of months, and then by March, when everything's back on even keel in terms of holiday distortion, etc., disappearing, you do get a much significant jump in the PMI numbers itself.
The bottom line here is below 50, new orders barely expanding, new export orders still very weak. The broad story is China's decelerating. It's not a collapse, but we need probably to see some policy measures to support growth after Chinese New Year. Otherwise, we might continue to slide.
What we've seen happen this morning is that, Eurozone inflation is quite low. The DAX index is now down, last I saw, 1.9%. So, the U.S. economy seems to be doing okay. I mean, there's a winter chill out there. The employment report next Friday is probably not going to be that great. But events beyond our borders now are starting to have an impact, and if that makes our stock market go down, I was kind of troubled by the fact that the European markets went down on this inflation number they have over there. I mean, some of the ECB members have said inflation there is going to run 0.8, 0.7 for a while, 3 or 4 more months, and they're not necessarily going to do anything at next week's meeting. But I think people they're hearing there's some sort of deflation out there, and deflation is equated with, it means, weaker economic growth.